Every so often, the market gives you a real puzzle. And today, we're going to deconstruct one of those puzzles. We're looking at a massively successful company that's somehow trading at a huge discount. We're going to break down the data, find the hidden barrier, and uncover the one big catalyst that could unlock its real value. So let's start with a number, 50.9%. What does this even represent? Well, it's a massive valuation discount. It's the gap between what a company is actually earning and what the market is willing to pay for it. The big question is, which company are we talking about? And is this discount a huge opportunity or a warning sign?
And the company is ITOCHU, one of Japan's largest general trading companies. Now, this is a massive, profitable, growing business. So why in the world is the market treating it like it's half off? That's the puzzle we're here to solve.
And this really gets us to the core question, doesn't it? We have a highly successful company that, on the surface, looks incredibly undervalued. So our job now is to dig into the fundamentals and figure out why this gap exists and, more importantly, what could possibly cause it to close. And here's that discount in plain sight. ITOCHU is trading at a price-to-earnings ratio of just 13.5. Now, compare that to the S&P 500, which is sitting at more than double that. And listen, this isn't some new thing. It's a persistent gap that really forms the foundation of this entire investment case. Okay, so before we can call this a value opportunity, we have to do our homework. We need to confirm the company's underlying strength. Is this actually a great business that's just being ignored? Let's build a case with some hard data. First off, just look at this alignment. We're seeing positive momentum across 3 different time frames. And what's really important is that all 3 are positive, with that long-term 24-week trend looking particularly strong. This tells us the current uptrend isn't just some temporary bounce. It's being supported by genuine, fundamental strength. And this chart, this just brilliantly illustrates the quality of that strength. I mean, look at this. Over the last 2.5 years, ITOCHU's stock price has almost perfectly tracked its earnings per share growth. This kind of direct correlation, that's the hallmark of high-quality, sustainable growth. It's not speculative hype. The value is real, and it's being created quarter after quarter. Now, here's where the story gets really compelling. While ITOCHU's earnings and its stock price were climbing together, its PE ratio, that's the blue line down at the bottom, stayed completely flat. Meanwhile, the PE for the S&P 500 expanded like crazy. So the market rewarded other companies with higher multiples, but not ITOCHU. This widening gap, that is the opportunity. So everything looks fantastic, right? We've got strong momentum, we've got earnings growth, and a huge discount. But our analysis shows that despite all these powerful fundamentals, there is one single critical metric that fails our test, and it's acting as a hidden barrier. And here it is. The company passes with flying colors on its Zacks rank and on insider confidence. Just look at that massive buyback program. But it fails on daily trading volume. Its average of about 30 to 37,000 shares is well below the 50,000 share threshold that a lot of institutional funds require to even consider an investment. It's basically an accessibility problem. Now, a problem like low volume could be a permanent deal breaker. But in this case, there's a very specific and imminent corporate action on the books designed to solve this exact problem. This is the catalyst, the key that could finally unlock this stock's potential. Now, for anyone who's not familiar, a stock split is actually a pretty simple mechanical process. The company just increases the number of shares out there, which in turn lowers the price of each individual share. The total value of the company doesn't change one bit, but it boosts liquidity and, you guessed it, makes the stock more accessible. And that is precisely what is happening here. ITOCHU has announced a major 10-for-1 stock split for its American shares, and it's going to be effective at the start of 2026. This is the key. It directly attacks that one failing metric we just found. So right now, before the split, the stock is trading around $120 a share. And for a lot of retail investors and even some smaller funds, that higher price point can feel like a barrier, whether it's psychological or just practical. After this 10-for-1 split, that same share is going to trade for around $12. Now, the total value of your investment is identical, but that lower price per share makes it way more accessible and appealing to a much, much broader base of investors. And what does this do to that volume problem? Well, based on historical patterns, a split like this is expected to increase daily trading by 4 to 5 times. That would push it well over that 50,000 share institutional threshold. The barrier is about to be removed.
Okay, let's pull all of these threads together now. We've seen the deep value, the strong fundamentals, that hidden barrier, and the powerful catalyst on the horizon. Now we can synthesize all of this data into a single, complete investment thesis.
So here's the summary of the whole thing. You've got a massive valuation discount. You've got strong and consistent earnings growth. You have management aggressively buying back its own stock. You've got a positive technical setup. And to top it all off, you have a perfectly timed catalyst designed to solve the stock's one major flaw. It's a really rare and powerful combination. So, what does this all mean from a strategic point of view? Well, the analysis suggests that the best entry window is right before the split happens. The key risk here has always been that the market will just continue to apply this so-called Japan discount. But the stock split directly mitigates this by removing that structural barrier that kept so many large investors on the sidelines. And that really brings us to the final question that defines this entire opportunity. All the pieces are in place. A fundamentally strong company trading at a deep discount with a catalyst on the horizon designed to remove the final barrier holding it back. Will the market finally close that gap and recognize its true value? Well, that's the billion-dollar question.